Anytime gold and silver spot price drops, there's a chorus of stackers on YouTube urging you to take advantage of the drop and buy more precious metals. But should you really buy the dip? Hey everyone, thanks for watching Yankee Stacking. You've heard it over and over. You've heard it from me. Buy the dip. But what does that even mean? And does it always make sense to do it? Does buying the dip work over the long term? And are there more effective silver and gold stacking approaches that might make more sense? I'm going to break it all down for you in this video, tell you what I do. Actually, check that. Tell you what I just did with these 250 silver dimes. I'll also suggest a hybrid approach that I use, and it might work for you too. And then I'm going to tell you the next buy on the dip that I'm doing this week coming up. So let's quickly define what it means to buy the dip. Put simply, it's purchasing assets when their price drops. That could be shares of a company stock, or in the case of silver and gold, when the spot price goes down. It's essentially buying precious metals when they're on sale. You get more bang for the buck, right? Or that's how the thinking goes. Buying the dip relies on a fancy term called regression towards the mean. That means ups and downs are temporary. They all average out to reflect a statistical trend. And that trend is usually up when the asset's underlying fundamentals are still intact, when they're solid, like in the case of gold and silver. Guys, the government is still spending way beyond their means. The deficit is still skyrocketing. The Fed will still print currency, still artificially suppress interest rates, still buy up toxic assets during the next financial crisis. Banks are still on shaky ground. The FDIC can't cover every depositor during a widespread bank run. Now, I could go on, but the bullish fundamentals are still there for gold and silver. All right, so let me give you a buy the dip example. Let's say you have $300 in fiat currency. If the spot price is at $30 an ounce for silver, maybe I could score some ugly cull or circulated eagles for $33 each. That's $3 over spot, which I actually just did recently down in Florida because I love me some cull eagles. All right, so at that price, $33 each, I could afford 9 ugly cull circulated eagles, just like these. 9 of them. But if the spot price drops to $27 an ounce, that would be a 10% drop. And these eagles now go for $30 each at my local coin shop, then I could get a 10th eagle for the same $300. Sounds good, right? 10 eagles instead of 9. And all I had to do is wait for that 10% drop. But herein lies the first problem. Most of the time, people are buying the dip with cash that is on the sidelines. They're waiting for a dip to occur. And depending on how much you're expecting the dip to be, this could take a while. Actually, it could take a long while. And during that time, guys, we all know what those dollars on the sidelines are doing. They're largely losing their purchasing power from inflation. That's sometimes called opportunity costs in investing. The second gotcha with buying the dip is doing it when the dip is from a much higher level. Now, follow me here. If while I'm waiting for that dip to happen, the spot price of silver rises to $40 an ounce, and then for some reason, it retreats back 10%, back down to $36 an ounce. Well, it's time to buy the dip, right? I mean, it went down 10%, yes, but now these eagles are selling for $39 a pop. And assuming that $3 premium, again, for the ugly stuff, instead of the 9 eagles that I originally could have gotten, when the spot price was 30, and now I can only afford 7 Eagles. Now that the spot price is $36 an ounce. You see the danger? Sometimes when you're so focused on buying the dip, you get a little too cute and you miss out. This brings me to another asset buying approach called dollar cost averaging. This approach focuses less on the asset's price and simply makes purchases with a set amount of money on a periodic basis. I know a lot of gold and silver stackers that follow this approach. I hear from them all the time. Yankee, I'm just buying, $300 a month worth of silver, regardless of the price. Sometimes I get more ounces. Sometimes I get less ounces. It doesn't matter. And if that's you, well done. Let me know who you are right down there in the comments below. The third way to buy your gold and silver is with FOMO, the fear of missing out approach. I bet I don't get many to admit in the comments that they follow this approach. This is when people, pile into an asset because it's trending up rapidly. And we saw that actually last month with silver when it rose day after day, and people heard about it and said, what's going on with silver? And they start buying. I'm not a fan of this tactic. I mean, you're chasing a hot hand, and you're likely to end up buying high and selling low. So we've got buy the dip, dollar cost average, or FOMO. And again, don't do FOMO. But between buying the dip and dollar cost averaging, which works best? With the stock market, specifically the S&P 500, over the long term, buying the dip only works a small percentage of the time, especially the higher the dip threshold you're waiting for. This is with the stock market, but I'm pretty sure it's similar with the precious metals markets. I don't invest much of anything in the stock market anymore, not since 2008. Right now, I have less than 5% of my overall wealth portfolio in things like mining and commodity stocks. I focus much more on real estate for cash flow and building wealth, and gold and silver to preserve my wealth. But what if you knew when the bottom for the overall stock market was? Look at that. That is amazing. It says that timing all your purchases all the time, even when you know the absolute bottoms, still isn't the best approach. But it can work sometimes, right? So my approach is a hybrid approach of primarily dollar cost averaging with some buy the dip mixed in. And I think my approach is especially good for those just starting to build their stack. Dollar cost averaging as the rule, buy the dip as the exception. And I did just that with these 5 rolls of dimes. $21 per face. I got them at. That's pretty much melt, okay? So shout out to David for contacting me and offering to sell his 90% silver to me. These are headed for my silver dime guardhouse box right here after the video. That was an opportunity I just couldn't pass up. I wasn't planning on exceeding my dollar cost average for the month of May, but I had to do it. You got to seize the chance when it shows up. And that brings me to another dip that I'm buying into this week. I mentioned I have less than 5% of my wealth portfolio in the stock market, mostly gold and silver mining stocks, with a smattering of other commodities like lumber, food and agriculture, and uranium. I am super bullish on uranium for a lot of reasons, and I'm not going to go into them in this video, but I bought in on uranium a couple years ago. And guys, I'm up 130% as of this video. No cap. It's my best performing stock in my model portfolio. Now, full disclosure, this portion of my video is being sponsored by a company that I first looked into about 8 months ago, Atha Energy. Now, I already had a position in uranium back when I looked at them and only put them on my watch list. I liked them a lot back then, but boy, do I like them a lot more today. And guess what? They've dipped, and I am buying this dip. Why? Well, because I want to add to my uranium holdings, and because the fundamentals have only gotten better for uranium and for Atha Energy. ATHA still has the absolute largest land package for uranium in the world's top jurisdiction, the Athabasca Basin in Saskatchewan, Canada. Guys, we're talking 4.8 million acres. It's massive. They have a sweet portfolio as well, with other properties in the Thalon Basin and Central Mining Belt. But the Athabasca Basin is the best location for high-grade uranium in the world. So they still have that. They still have a stellar leadership team. They still have excellent finances. Actually, their finances have gotten even better. They recently raised $60 million Canadian in 2024. That's the biggest financing in uranium mining in years. Now, of that $60 million already raised, they are spending $30 million of that on drilling. $30 million on drilling. That's absolutely amazing. I can't find any other mining company willing to fork over that much cash to drill for anything in Canada. And speaking of drilling, I just read that they've started drilling earlier this month. They are going to drill, baby, drill for uranium every day, rain or shine, all year long. We're likely to see drilling results every week. Now, traditionally, a nice uranium discovery will likely translate into a 10 to 20% pop in a miner's stock price. And if they make a huge discovery, guys, ATHA Energy could be a $1 billion company in short order. And I'm not just blowing smoke here. I'm seeing recent analyst price targets of $3 a share Canadian. Now, in December, ATHA Energy merged with two other companies, Latitude Uranium and 92 Energy. The three together have created an asset base that is unparalleled across the entire uranium space. This merger, is awesome, but it could also explain some of the dip in their share price. I suspect that most of those who sold their shares, dropping their price, weren't ATHA shareholders, but probably Latitude Uranium and 92 Energy shareholders. I don't know for sure, but that's my guess. But much of what I've seen is low volume activity over the past few months. Finally, guys, they're having a 50% off sale right now. Okay, like I explained earlier with the silver, I can get twice the shares in ATHA Energy now than what I could have back in October. Again, what ATHA Energy already has in terms of valuable land is incredible. In the history of mankind, there will never be a larger position in the Athabasca region. So yeah, I'm not just buying the dip, I'm buying the execution that ATHA Energy has just embarked on. By the way, the Sprott Junior Uranium Miners ETF added ATHA Energy too. That's huge. Now, I always say this, it's really important, but don't buy a single share of ATHA or any other junior miner because I or any other guy on YouTube is telling you about them. I'm not a professional financial advisor. I'm not recommending that you become an ATHA shareholder. I'm just cluing you into them again and telling you what I'm doing with my own personal financial situation. You do you. But frankly, I think there's no other uranium company that has this much upside with this little risk. So if you're looking at the uranium sector at all, make sure you check out ATHA Energy and consider whether you should buy the dip with them, along with your silver and gold. Well, thanks again for watching. I really appreciate it. And as always, I hope your day is A-OK.